Hey, welcome back. My name is James Johnson. My expertise lies in retirement and estate planning. And the topic that I'm going to talk to you about today is I'm going to talk to you about the 3 reasons to not claim your Social Security at age 62. Now, this is an overview of how Social Security works, and for you, it may or may not be different. But the bottom line is when you're done here learning this information, you're probably going to want to set up a session with me so that I can run your Social Security in our Social Security system and give you a good idea of when the right age is to claim it. And probably the most important thing to understand about this is to not be claiming your Social Security based on thinking that you have to, and not focusing only on Social Security, but focusing on your whole entire picture. So when we go over here, I'm going to get this thing set up here. When we go over here, the first reason to not do it is because if you do the right planning and you claim your Social Security at the right way and you optimize it, you literally can get more than $100,000 more out of your lifetime by claiming it the right way, or $100,000 less by claiming it the wrong way. So the relationship between claiming it at 62 and your FRA, your full retirement age, which is where everything is determined. So your full retirement age is going to be somewhere between 66 and 67, depending upon when you're born. And that determines what's called your PIA, your primary insurance amount, which everything is calculated off of. So in this case, if this person took their Social Security at age 62, they'd get 75% of their full retirement age. If they waited till 66, that $1,125 would be $1,500 a month. And then if they wait all the way out till age 70, it's going to increase by 8% every single year, and their check's going to be $1,980. So that's a pretty considerable difference between those two numbers, and over time, it's a very large difference in the amount of money that you actually receive. Now, if we look here at claiming at age 67, having our full retirement age at 67, and claiming at 62, we only get 70% of our check instead of 75%. At age 67, or our full retirement age, we're going to get $1,500, and at age 70, we're going to get $1,860. Now, make no mistake, it makes 0 sense to wait past age 70, but often it makes sense to wait as long as 70, or at the very, very least, your full retirement age. So how will working impact your Social Security? Now, the first time I learned this, it was kind of depressing, because here's the reality, is if you take your Social Security at age 62 and you're still working, any money that you make over $19,560 will reduce your Social Security on a 2-to-1 basis. So let me give you an example of this. Let's just say, for example, that your Social Security is $10,000. That's the amount of Social Security you receive, and you made $39,560 in that year in earned income. If you made $39,560, that is $20,000 over the $19,560 limit, and you would get a check for 0. But worse than that, you would be locking in your Social Security at that low age, and it's not going to get that 8% roll up over years. It will only increase by whatever inflation there is during that period of time. Now, if you wait to take your Social Security to full retirement age, in the year you wait to take your Social Security to full retirement age, up to the month that you turn full retirement age, you can make $51,560. Anything above that number, up to the month that you turn full retirement age of $51,560, is phased out on a 3-to-1 basis. If it's 63, 64, 65, it's relative to each year. It gets a little bit higher and a little bit higher on the deduction portion. After full retirement age, you can make as much money as you want. You can make $3 million a year, and there's not going to be a reduction in your Social Security. So remember, during the year in which you reach full retirement age, you can make $51,560 up to the month before your full retirement age is set and not have a deduction, but any money after that that's made above that 51,560, that would cost 3 to 1. So another reason why we don't want to take our Social Security too early is because of longevity. See, the reality here is that we're living longer. And what I tell people is live like you're going to die tomorrow and plan like you're going to live forever, because you just might. And I can't really tell you which one it's going to be, but if you can tell me the day you're going to die, I swear to you, I can create a plan that I'll bounce your last check. But based on the fact that you can't do that, you have to assume you're going to live a much longer period of time. So when we run your Social Security timing report, what we're going to be able to tell you is, if you look out over here, we're going to be able to tell you at what point which strategy becomes a break even. And for most people, that's going to be out around 80, 81, 82, where it makes more sense to take the strategy of waiting longer than it does to take the one of taking it immediately. And also factoring in the fact of if we're going to get phased out by taking it too early. So what if we die at age 85, 86, whatever the case may be? This report is going to show us where we can go over here, especially in a married couple, and we can see, well, John makes it here to age 80 and Mary makes it up here to age 85. Then this first suggested strategy is the one that makes the most sense. And in this case, it's probably both of them waiting until age 70 to take their Social Security. Often, it's one waits till 70, the other one takes it at full retirement, and occasionally one waits till 70 and the other one takes their Social Security as young as 62, and that all is dependent upon how much money they're making and where their other sources of income are coming from. So what if we need cash flow sooner? So that kind of boils down to, should I ride the white horse or the black horse? Do I ride my assets or do I ride my known incomes? My known incomes being my Social Security, my pension, my rental properties, what other incomes that I might have, and my other assets are my 401k, 403b, 457, etc. So once again, the alternative strategies will give us a good idea as to when the best time is to take that Social Security, so we can figure out where to go from there. Now, each strategy is a little bit different, but the greatest thing about this software is it's going to break it down and it's going to show you the difference on living out to a certain age, how much more money you're going to get by taking one strategy over another. You can see here the earliest strategy is $964,000 over that period of time, whereas the first strategy, which is taking it later, is $1.157 million. Well, that right there is literally a $200,000 difference in that period of time. And $200,000 out over most people's lifetime between 62 and 85 is going to be a pretty considerable number. So, Social Security benefits will increase by 8%. There is nothing out on the market today that can guarantee us that it will increase by 8% every single year that we wait. So often it makes sense for us to wait to take our Social Security later. So what if I screwed up? I went and I filed already. I filed at 62 and I was watching this and I realized that, I shouldn't have done that. Well, the government gives you what's called a do-over, which means that you get a once in your lifetime do-over where you're able to go back, file a Form 521, pay back all the benefits that you've received, and then suspend your Social Security so it goes back to growing up to be a much higher number. The trick with this is you must not have been filed for your Social Security longer than 12 months ago. So if you've been receiving it for longer than 12 months, there's still some strategies that we can do there. But for the most part, the reality is that if you filed before your full retirement age, and it's been less than 1 year, you can fix it by using the do-over strategy. If it's past 1 year, then at that point, all we would do is suspend it and let it grow back up. So why don't I just go to the Social Security Administration and ask for advice? Well, the Social Security Administration looks to get the highest monthly benefit on the day you file. The Social Security cannot give you advice, and they cannot coordinate benefits with your other outside assets. So if you're just focusing on one thing like Social Security, I promise you, you're making mistakes across the board. You really need to be taking a 100,000-foot view of your overall financial picture, your real estate, your pensions, your 401ks, your taxes, inflation, when you're going to need this money, etc., before you make a real decision on when the best time is to take your Social Security. The value of professional financial advice is, there's no limit to it, because the reality is that you're going to get a clear picture about how your retirement works. I use some very sophisticated software that can tell you exactly when you're going to run out of money, or if you're going to run out of money, what your income is going to look like, how much your income needs are going to be, what the taxes are you going to pay based on today's tax rates, and the possibility of what the tax rates will be tomorrow, inflation, et cetera, et cetera. These are all things that you're not going to get by just going out, taking a calculator, and making that calculations. There's way too many calculations to be made, and you need a pretty sophisticated software and a knowledge of how this stuff works. And how do I fill the gaps? See, in order to retire, you got to have one thing, and that one thing is a paycheck. So you're going to have known incomes. Your known incomes are going to come from your Social Security, that in most people's case takes care of about 40% of their need for retirement. Pension, if you're lucky enough to have one. And then possibly we could say a known income was rental property or possibly some annuities. But the reality is that's most people's known income. Then you're going to have a need. That's this number up here. This is the amount of money you actually need to live on. And you're going to have a gap between those two. That gap is going to have to be filled by your other assets. And your other assets being your IRAs, your 401ks, your 403bs, 457, defined benefit plans, whatever the case may be. Now, I can sit here and give you a class for hours on qualified money, which is your IRAs, 401ks, 403bs, Roth IRAs, etc. But what you really need to understand is just kind of what's the difference in these different types of accounts that you have, and how do you start taking what are called tax-wise distributions when the time comes to take your money out. Now, the cool part about any kind of a qualified plan is you have a potential for matching. So if you put in a certain amount, your employer puts in a certain amount. And make no mistake, if your employer is matching, you should be putting in at least up to your match. Whether you put in above your match, that's a debate for a different day. I have lots of videos out there that talk about that and how taxes are on sale today and how you should probably be moving to Roth IRAs and all that good stuff. But this is a Social Security class, so let's stick to Social Security. So the contributions that we put in qualified plans, with the exception of the Roth IRA, are tax deductible. There is a potential for loss due to market returns. They're fully taxable at distribution, except for the Roth IRA, and you take the risk of investment decisions and income distribution. Now, when we look at our other investments that create dividends and interest, such as stocks, bonds, mutual funds, certificates of disappointment, you maintain control over your account. You have a potential for tax advantage in the form of long-term capital gains, and taxes are paid only on earnings. The cons are you still have to pay taxes. There's a potential loss due to market risk, subject to reinvestment risk, no guarantee to principal protection, growth, or income, and you take the risk of investment decisions and income distribution. Now, here's that terrible word that no one likes, annuities. And when I teach a class, and I've got a lot of people in that class, I always go around the room and I ask people, I say, hey, what's a CD? And the answer is, well, you put money inside of a bank account, they give you a fixed rate for a fixed period of time. End of the year, they send you a 1099 and you pay taxes on it. If you take it out too early, you pay a penalty. So what is an annuity? And they always say the same thing. I can go in there and I can tell you 95 to 100% of the room is going to say, look, an annuity is a terrible thing. You give them money to the insurance company and then they give you a set amount of money for a set amount of time. Well, see, that's a fallacy, because that's what's called annuitization. And that is the common belief amongst most people, because they're listening to what the mainstream media is teaching you. There are billions and billions and billions of dollars in annuities. There must be something good about them. So what an annuity can do for you, okay, is it can maintain control over your account. If it's non-qualified money, it's tax deferred on earnings and no mandatory distributions unless it's an IRA. Potential for guaranteed principal growth and income for life. And the one thing that an annuity can do for you that nothing else can do is it can provide an income stream that will never run out. Even when the money runs out, the income doesn't run out. And with today's annuities, we still have access to our account. And if we die prematurely, that money goes on to our heirs and not onto the insurance company. So don't believe everything you hear. And as a matter of fact, if everything you thought to be true turned out to not be true, how soon would you want to know? So if you got questions about that, you should probably go onto the YouTube page and go under playlist and go watch information on annuities and learn more about annuities and how they should be in everyone's portfolio in some fashion or form. They often require a longer term commitment than, say, a CD, but the reality is you don't pay any taxes on them at the end of the year. They're tax deferred. They create guaranteed streams of income that you can't outlive. Now, another asset out there that most people are simply not aware of and that could be used inside of your retirement and in conjunction with your Social Security is life insurance. And most people have absolutely no idea what I mean when I say life insurance because most people have death insurance. They bought the most insurance using the least amount of money for the purpose of dying. And this rule is set by the insurance company. If you do life insurance correctly and you use it for some of the purposes it can be used for, you build what's called a permanent life insurance policy, where you build a maximum funded policy under the tax laws of TEFRA, DEFRA, TAMRA, 7702, 101A of the tax code, and you buy the least amount of insurance using the most amount of money for the purpose of living. By doing that, you get to grow your money tax-free. You get to access up to 85% of it at any time tax-free. Put it back if you want. Get most of the gains of the market. Never participate in losses. And when you die, it passes on at 2 to 3 times that amount tax-free. So this can definitely be one of those known sources of income in your life when it comes time to retire. The cool part is you get to control your account. It's income tax-free loans, withdrawals up to cost basis, no penalties for early access, no required minimum distributions. And if you don't use it while you're alive, you pass it on leveraged to death benefit to your heirs tax-free. Now, keep in mind, it takes time to build one of these and it's not for everybody. So what you should do at this point, if you want to get your Social Security report, is you should scan this code. So take your phone right now, put it up here, scan the code, and go out to my calendar appointment list and set up an appointment for us to do your Social Security report and then help you build a retirement report that'll tell you whether your retirement plan's working or not. Be sure to subscribe to our YouTube channel below. And remember, live like you're going to die tomorrow and plan like you're going to live forever because you see, you just might. Keep smiling and make it a great day. Hope to see you soon.